Hey, hello folks. Welcome to Pro Trader Strategies. This is my webinar course on our options guide to cracking the code to trading options. All right. What we're doing here is we're going to build from simple concepts to real life examples throughout this video. So I'm going to try and talk to you in layman's terms. And then once we get to talking about options, I think that you guys are just going to follow right along because we are going to build on that incrementally until we get to the crescendo, I guess, if you will, for lack of a better phrase. Anyway, so our guide to trading options, this is cracking the code. Before you go, please smash that like button for me. It helps out, and subscribe. Sometimes I'll pop in here unannounced, especially during the day while the markets are trading, and start talking about the market. So if you guys want to be a part of that in real life examples there, please hit the subscribe button with the bell. The bell is the key, I guess. All right, so cracking the code to trading options, let's get on with it. This is going to be on the long call spread. I'm going to build from, we've started out with a long call and the long put, right? We talked about the type of volatility we would want to see for those type of trades. I'm going to do the same thing with this, where we build to that. We all don't walk into a day and think that we're going to start trading a call spread, all right? Just because you're bullish on the market. Do you go and just default to a call spread on a bullish move? No, I would say that you are putting yourself in a corner if you're doing that. I'm going to tell you why probably closer to the end of this video, because we'll build to that. As a matter of fact, I think you'll understand it intuitively before I even have to say it. And I'll show you as we go through this. So with all that said, let's make it simple. It's just like these folks that are doing computer programs. When a program is running, it's O's and ones, folks. And that is all it is in its simplicity. So you can't get any more streamlined than the code in the background here. So that's what I'm going to try to do with you folks here, is build from something like this. And then at the end of it, the understanding that these things just meld together so easily, you won't be even thinking about how difficult it once used to be. Like looking at this X's and O's, sometimes that looks like you're looking at the option montage or that page with all the strikes and everything else. Well, once you start getting through this video, I think when you start looking over there, things are going to be a little bit more clear. So let's talk about this first. Real life examples. Who's bought a house in the last couple of years, even just in the last 2 years, and seen what's happened to home prices? I talked to this woman last night at a banquet, and she was telling me that she moved here from Kentucky in 2020, bought a place way up north of me in Cave Creek. It's a nice little community, but it's not really, it's really far out of the way, to be honest. It's a nice place if you're going to retire, but she had some kids. Well, she lived there for about a year and was able to sell her house for a 70% return on her investment. That is insane in 1 year on a house. She was actually able to move closer to the school and bought a slightly smaller house, but still, the fact of the matter is we have seen housing prices scream higher, right? What's that from? It's from folks moving out of the cities and moving into more rural areas, and that's driving home prices up a lot of places. Even the Californians coming out of California, they're used to those super high prices, and they go everywhere else, and it doesn't seem that expensive, right? So they're driving that price. But what happened not too long ago, we saw housing prices actually do something very similar to this and crater. So we've seen housing prices dramatically drop, right? And all of this is due to supply, demand, and volatility, all the things that we talk about in the overall markets. So while we normally see housing prices screaming higher, they do have a tendency to have some pullbacks. You know, some folks during the pandemic actually thought right at the beginning of the pandemic that we might have a housing crisis. Well, our housing crisis was the fact that people were doing urban sprawl more than anything else. But we can see the markets scream higher and still correct on even assets that generally have upward momentum. So while what I'm trying to say here is, even though we usually see those housing prices move higher, you don't always know if you're buying low and selling high. That's what everybody tells you. I mean, it just seems like such a novel idea, doesn't it? Folks, when you go out there and buy stocks, just buy them low and sell them high and you're all good. Really? Well, what's low? What's high? Nobody knows when you're talking about stocks, right? Not really. Well, we know zero is low, all right? That's about all we get. But from the IPO, you know, all of this forward-looking, getting multiples on their forward sales or earnings, all of that is very convoluted. Well, the guy is only 20 times his earning, and this guy's 10 times. Well, so what? That doesn't tell me if the price is high or low. So when folks are just saying buy low, sell high, to me, it blows my mind. It's like, how do you know what is low and what's high? Joe Terranova wrote a book. He's a guy from CNBC. Anyway, he wrote a book, Buy High, Sell Higher. That makes more sense to me. Probably to you too, is probably why he wrote that book. To buy low and sell high, you never really know what low is, because low could really be, in your eyes, thinking you got a pullback. Well, if you don't know anything this way, this could be the buy low if it continued higher. But, you know, it's easy to say, yeah, you buy down here, buy low, sell high. That's so easy. And then you buy low, right? It's so easy, and sell high, buy low. I mean, it doesn't get that hard, and then you sell, right? I mean, everybody can do that. The problem is we don't have these charts showing you the future. So we don't really know what is low and what's high, because we could easily get caught into a trap. Like, had we missed this low, we could think we were buying low here at this second level where it pulled back before. It doesn't matter. Maybe it came here and you missed it right here. Said, you know what? I don't like that pullback. I'm waiting for this, and that never happens, okay? Market shoots higher. Now you're like thinking, gosh, I wish I would have bought it. And then we correct down and you're thinking, all right, I'll buy it here. I missed it. I missed this time and I was angry. I knew it was going higher. I got this opportunity on a pullback. I'm going to look. Oh, Ron, I do this almost every time, it seems like. Let me try and erase some stuff. I'll start over because this is too important. Thank you, Ron. I appreciate you. Even though I'm getting red-faced because I did this again. We can't see anything ever. No wonder I was losing folks. I'm trying to erase some of my ink here as I go. All right. All right, ready, guys? Take two. Sorry about that. All right. Now that we're on to the options guide, thank you, Ron Wilkins. Can probably see the chart now. He got me to start over for you folks so everybody can be on the same page. All right. Options guide to trading. This is our options guide, cracking the code to trading options. All right. So like I said once before, or some people might have missed it, we're doing the long call spread here. And while we're doing the long call spread, we're going to kind of forget about that for a moment, because at the end of all of this, we've started with simple concepts. We build the real life examples, just like I did in the long calls, just like I did in the long puts. Thank you, Ron. I appreciate you. That's exactly what we're looking for going forward, is start out with something simple, come up with our idea, and then by the end of this is going to make a lot of sense to you guys. I can assure you that. So one of the things I was talking about before without a screen, and you guys had to look at my massive head, was we're going to try and make these options simple. And just like programmers with code, you know, when you look at somebody writing code, it looks so confusing because we just don't understand that language. And same with like this, the O's and ones with a computer. Now this actually transfers massive amounts of data and it's all different. but it ends up being O's and ones because it can't get any simpler than that. Basically, that's what I want to do with you folks, is take something like this where it just doesn't make sense with all the O's and the ones, and you're looking at the option montage page with all of the options and the pricing. Sometimes it can feel a little confusing like this. Well, I hope to get you guys past that in basically one webinar where you can really look in on the option montage page and focus your eyes to the places where it really is impactful, okay? So you can wipe out some of the rest of the noise there. So here's what I was talking about with the housing market. We always assume that housing prices are going to continue to climb. But some of us, back in the early 2000s, we saw a housing crisis where the market did blast off to the upside, but then we got a crisis and the housing markets started to go down and prices could fall almost to, I had a house in Chicago that dropped like $300,000. So we can see this massive upside, but there is still downside even in the housing market. So when folks tell you you should buy low and sell high, what does that mean? Like, what is a house worth? It's worth what somebody's willing to pay for it, right? And the reason why these housing prices fluctuate is due to volatility. There's no other reason for it. Volatility on the upside from the demand of all these folks wanting these houses to the panic, like just before right as we were entering the pandemic, is some folks got a little nervous. Are we going to have another housing crisis? I feel like I paid a lot for my house. I'm selling it. And they thought they were selling it high, but they were probably selling it low and somebody was scooping it. I talked about a friend of mine a person I just met last night was talking about her house up in Cape Creek, which is literally way up north and kind of in the middle of nowhere. At those folks, somebody came and literally knocked on her door and offered her almost twice as much for her house that she had just purchased 6 months earlier. It was a 70% return on her investment. It's a little skewed because she probably didn't put, the full boat down, but it was a 70% return on investment. That's massive. So while folks always talk about buying low and selling high, it doesn't always make sense because there's no real way when you're talking about different types of assets to absolutely know the bottom. Nobody ever picks the bottom tick, okay? Buys that bottom penny. As close as I've been through my 30 plus years of trading stocks, futures, spreads, everything, ETFs, grains, I've never bought the low tick or sold the high tick. Okay, it just doesn't happen. But you want to try and buy as low as you can. So obviously you want to buy here and then sell up here. We buy here and sell up there. It's so easy, right? It's such a novel idea. But what does that really mean? Because at the end of the day, folks, we don't know after the markets start moving what really is low and high, right? In a sense, we could be looking at, thinking this was the low in your buy, right? Or maybe you missed that one and thought this was your buy, right? Or this was, you could have even thought that this was your buy because we started getting a bit of a correction. You're going to start moving higher. So while it's a novel idea to say, let's buy low and sell high, there's no easy way to determine what's low and what's high. You could have thought on this market move, all right, I missed this opportunity here on a pullback this time. Like, oh, I love this stock. It's going too fast and too high. It pulls back here and you question yourself and you miss the move to the upside, but then it gets a little bit of a correction. And now you're thinking, I've got to buy because I missed it over here. And this is obviously a support level. Well, you get a little bit of a bounce and it slams back down to this basic low here. which everybody would say that's where you should be buying it once it comes down there a couple of times, right? But we don't ever even know if it's going to get back down there. So sometimes you could buy low and then sell lower, right? Lower. That happens because we don't always know when price is high or when price is low. But sometimes, you know, some of you guys out there are probably better chartists than me, and you'd be like, well, of course, Wolfman, there's a triple bottom there. And I gave my slide away. There's a triple bottom here. That's definitely a buy area. Well, you got basically a line in the sand here that could have been your resistance area too. But, you know, you guys throw it over there in the side. If you guys see me making a mistake on my technical analysis, throw it out there. I'll be happy to listen to some of you guys out there because I'm sure you studied it more than I have even. All right. The one thing about options is they give us a little tell as to whether or not they are cheap or expensive. Now, it doesn't tell us when it is extremely cheap or extremely expensive. Well, I think it does, but it means it could, what I mean by that is it could get cheaper or it could get more expensive. But with options, each individual stock has its own range bound volatility coefficient. Okay. Now I hope you guys all don't start running away with me saying that, because all I'm trying to say is when we look at a stock, it looks very similar to that last volatility chart. There's the buy low, sell high. What we see with volatility is that it wants to stay in a range for that underlying. So when I'm saying an underlying, I'm talking like Apple and its volatility. I'm not talking about the VIX versus Apple's pricing. That is comparing like apples to watermelons, all right? And comparing apples to oranges would be like looking at Apple's volatility versus Facebook's volatility and trying to determine who's cheaper. That doesn't work either. Volatility is a product of that underlying. Now, the VIX judges the overall volatility of the stock. So it's a melting pot of volatility. So while it shows us volatility for the broader markets, it doesn't really tell me what this individual underlying is seeing. Like, we're seeing a lot of stocks across the board feel heavy volatility, but there's some other ones in there that just aren't. And we would expect them to, like the example I have for us today. But volatility does look like this. I look at volatility and try and hit these tops there. So yes, it will break out in some areas. And then, you know, obviously that's probably your best bottom, but volatility can go a little bit lower. And listen, we can't always nail the top and the bottom, but what we know is when volatility is at these lower levels, if volatility is down at this level, we know price is cheap because volatility has a rule. It tells us that when volatility increases by 1 percentage point, then our options prices increase by the Vega coefficient. All right. And just know that Vega is implied volatility. Yeah, everybody knows it's volatility, but it is specifically implied vol. All right. And that we see show up in a lot of different places than Vega does. Vega only shows up in the option montage, and all it is that Vega is implied volatility, folks. So whenever you see Vega, just know we're talking about implied volatility. So the idea is, if this is looking at, let's just say IBM or something, IBM, that's not a very good B, IBM. So when volatility gets up near this upper area, I know that options are expensive. They're pricey. Let's just say they're worth threes. And down here, options are basically a $1 sign, meaning they're pretty cheap. Because while everything else is going on in the option world, what we see happening is that volatility at any given moment, moving up or down, is affecting our prices. Now, one could say that the price of the underlying moving up and down affects those prices, and that's true. I'm not going to debate that right now. What I want to talk about is this volatility is actually influencing the deltas and everything else. So we need to look at where Vega is first before we look at anything else, because Vega, or implied volatility, is going to tell us the key to whether or not these prices are expensive or cheap. What would you guys do if prices are cheap? If I told you option prices are super cheap right now, what would you think would be the first thing you would do? It doesn't, I'm not talking directional assumption, but if I said it's cheap, you're immediately thinking I would buy it, right? And if I said that those prices are expensive, then you think you would need to sell them. Now, I don't want you just to go by my word on this. We're going to go through several examples here. By the end of it, I think you guys will have the comprehension that volatility at any given moment is more impactful to pricing than anything else, okay? And that's what we need to exploit. So this is volatility in the markets. That was a simple concept. We'll go to real life examples here. But what we can see, and it doesn't matter what underlying this is, it is, I'll give you a hint, it's deer. We're going to go into deer here in a minute. But it could be XYZ, all right? And XYZ right now is at 28. But what we can see over the last year is that the high usually gets up around this, let's just call it 30, let's call it 39 being that high-ish area. So if volatility is up there at 39 for Apple, I know it's expensive. And when it's way down here at, let's say, let's call it 19, just to make my math easier right now. So 19 being this low, then where is volatility in relation to the high and the low, right? It's kind of right in the middle. Right in the middle, because this is 29 really, right? So we've got 29 there. So it's right in the middle. What I would say is that it's pretty tough to tell if prices are expensive or cheap. They're literally right in the middle. But if this underlying had the volatility go down to here, it doesn't matter what time of day it is or what day of the month it is. I would know that if volatility is cheap, then, or volatility is down here, then I know XYZ's options are cheap, right? Same thing here. If it popped back up here, I would know that they were expensive. Okay. And I'll show you how this works out. Now, you might be looking at this like, hey, you know, it spikes in and out. You know, when we had the pandemic, yes. When we had the pandemic, when there is a black swan event like what we had with the pandemic, yes, we will get a volatility spike that is a little out of the normal. All right. We can't look or fear that going forward with volatility. All right. What we have to do is look at what's happened. And I could scroll back the last 20 years. This is actually a 20-year chart. I don't know if it says 1 day, but it's a day on a 20-year chart. It shows 3 of those years right here. So we can see even before the pandemic, it was pretty close to this range that we're having right now. Now, I let the line be a little bit higher because I want to capture as many of those bottoms as I can. All right. I want to kind of clip them all because that gives me an idea that, hey, that's super low. Yes, it can go cheaper, but I'm only looking for it to kind of reach as close to those extremes as possible. So I kind of want to have some of those data points pierce a little bit maybe on what I feel is an extreme spike and discount that a little bit because it's not going to happen that often. So you can see on this chart, even with deer, yeah, this year it has that range, but even if I back it out, we can see that the range for this is pretty darn tight. I zoomed in on this for you. This is the massive spike that we got from the Black Swan event on the pandemic. Nobody knew what was going to happen. I don't think that we're going to see that happen very well or very soon, anything like that, especially with this. So with that said, I can't live my life in that fear of volatility spiking too high or volatility really spiking too low. I have to find where my comfort zone is, and I would suggest you folks do that as well. With that said, on a long call with an underlying moving up, can the option not be profitable because Vega didn't line up? Yes, Roger, that is exactly right. The timing is everything with options, and I'm going to talk about that. Like, for instance, Roger is on this, and probably a lot of you other folks are probably thinking the same thing. You're getting those levers and pulleys going, right? In the brain. If I was looking at volatility for this underlying right now at this level, what would you want to be doing with this one? I took this as this is still dear, but I took it a couple of days later, and the volatility has risen a little bit. But volatility has gone up a little bit. Now, what are you thinking here? Volatility is starting to get high, and that means prices in the options are getting expensive. All right. So that's where you start building your strategy, is based on what you think the prices are. Does that make sense to anybody but me? I hope it does. If it does, smash that like button for me. I'll keep my eye over there and see if it starts clicking. But when you get above that, so for newer traders, something that we talked about in the other webinars that you guys may not have been in, you know, we talked about when it's right here in the middle, you kind of really don't know if it's going to go higher or lower. But when it starts getting up to these levels, this above that 50 is sell options zone. And when it gets below that 50 area, it's buy options. Now, if you're newer to options trading or a lower risk tolerant person, I would suggest you kind of do this in quarters even, right? Where you don't even just go 50-50. You could even go in quarters here, where you say, now this is your just buy calls and just sell calls, or something, you know, where you're not really layering on any other part of a strategy, just naked, if you will, naked buying options or naked selling options there. So you could say those extreme quarters is where that would happen, where you're not hedging yourself as much. Or adding a little layer of risk to that outside boundary, because you know you're buying it super cheap or selling it super expensive. And if you get these spikes where you can capture it, where it catches up on this topper area, and you get that volatility crush coming out of it, like this is doing quite often, that's where you make money quickly. This underlying wouldn't even have to move a penny. If I just got that volatility coming out and I had sold those options, I would have made tons. And if I had gotten in volatility when it's really low, especially on that one, again, it doesn't matter. Like the financial crisis during the pandemic, we were seeing the market sell off and the calls increasing in value. Right? I'll repeat that, right? Because a call is generally considered a long bias, right? I buy that, I profit from an upward move. We were seeing during the financial crisis, even the 2000 crisis, the .com crisis, we were seeing calls explode in value despite the fact that the underlying was free falling. All right. So, and that is a product of volatility. Those prices increasing in value due to the expansion in volatility. And volatility, really, this expansion, this blow up here is just saying that it just says the range of the trade in the underlying is going to be massive. We're no longer in these tight little ranges. The expected range is now going to be like that. All right. So that's what volatility is trying to give us a hint to. And that's why those prices increase, because of the risk involved in that. So The black swan event, yes. This is a bit concerning, but I discount it because we probably won't see something like that happen for another 10, 15 years. And we're kind of back. You know, Apple used to might have had a bigger range, but now I'm just saying it's between here and here, and I'm good to go. And then taking a look at Deere, we could say that on this 1-day chart that we're looking at, that volatility at that level, I would say that is expensive volatility, right? Down here, it's super cheap. And I already showed you the line going back in time. I think I redrew those lines a little bit on this one to try and clip the tops a little bit better on a few of these here. But volatility, at the end of the day, if you don't walk away with anything else, like, dude, that guy was talking with marbles in his mouth. I couldn't understand him. He might as well have been talking gibberish. Is if you come away with knowing that volatility drives pricing in the options, and that is going to determine whether you buy or sell options, I'm all good with that. Seriously, I'm all good with that because I don't want you to make the silly mistake of, hey, you know, Wolfman said you got a bullish assumption, go out there and buy calls and forget about the volatility part of all of it. To me, that's the volatility part of it was what told me I wanted to buy calls. Okay? Does that make sense for everybody? Makes you think gravity no longer applies sometimes with the volatility, and it does. You're right. So with that said, the expected range on these massive spikes is just volatility is saying, hey, I expect a bigger range in this underlying. And yes, when you are selling options in that kind of environment, you're saying, I just think that you guys are crazy in buying all this volatility. It's really not that bad. All right. Because I've seen the last 20 years of volatility for Apple, and it really hasn't gone outside of here other than during the Black Swan or this pandemic and the financial crisis. Right. That's not something I want to like look forward and say, all right, well, the Ukraine thing is going to do nothing except for startups, and don't get me on that soapbox. Startups are going to be hurting. I do feel bad for those folks because they are not having programmers. They have no programmers to help them. All right. So what do we immediately recognize from now this chart? I'm looking at Apple. What would you think would be if I'm looking at this range for volatility? Well, I also have to do a little bit of thinking with myself and think, you know what? Volatility is pretty low for this underlying. I expect volatility in the environment we've been in to start moving higher. I also have, now this is yesterday's chart. We do have a red candle here today. But I've talked about that. This volatility, we're just working through some inventory here, folks, where the weaker hands are kind of getting out of some stuff, and it's sector rotation out of the NASDAQ, which I fully talked about in our spotting the trade videos, folks. So smash that like button and hit the subscribe bell. I'm not talking about subscribe to our channel. I'm talking about that little bell right next to it. If you hit that button, subscribing that way gives you a notification when I do my spot the trade videos, which are basically sometime during the day when I find an opportunity. So please check those out as well. The other thing, I expect volatility to rise here going forward. So if I expect volatility to rise, then what does that tell me? I expect prices of the options to start rising as well. I'm sorry, you guys. My son just came home from school and a little bit early. I thought he was going to his girlfriend's, and these dogs are probably going to tear down the wall trying to get out. So bear with me for a moment till they forget. All right. So we know that the options pricing in this case are pretty cheap, and I want to lean towards buying it because with the volatility we've been seeing, I've got to lean towards volatility moving higher. You look at only implied volatility or implied volatility percent. That's a great question. I look at both. And what I'm trying to do here is I used to go through all the math, and what Perry's talking about here is we can do it in a couple of different ways. And I'm going to do it since Perry got us on this. Well, we're going to go through this. So the idea here is you can kind of ballpark it. All right. You know when it's at extremes. Okay. So if I thought that was the 50 mark, this is the 100% mark, and that you can kind of get your eyes around that when it's at the extreme levels. But there is a formula that you can, I actually have the code, the script for that you can put in Thinkorswim. But what we're trying to do here is determine through math whether this is high or low. So, and we're only going to look at this particular underline because I only care about Apple and comparing apples to apples. All right. So I know that was bad. All right. So what you do is you take the current implied volatility and subtract that by the low. So really what this part of the equation does is tell me where this number is in relation to this low. It tells me how far off the low I am, okay? And then so I take that sum and divide it by the entire range, or the high IV minus the low IV. So what this ends up doing is giving me this point here. Now I'm going to try and do this math in my head as we go, so bear with me, and I'm going to round. So I'm going to go say that's 35. So if we have the current, it's 35 minus the low of, why don't you want to do that? The low of, what are we going to call this low? What is that, 35? So let's just call this low 20. I'm just going to call this 20 down here, somewhere down there. 20, all right? And then the high, let's call it 55. So I have that sum, and then I have the high minus the low, 55 minus 20, and I've got to come up with this math. So 15 equals 15 divided by 35. So what is that? It's just slightly under the 50%. So what is that, 45%? Can somebody pull a calculator up for me? So I guess I pulled up the calendar. Anybody got a calculator? Calculator, where's my calculator? I'll try and do the math real quick. I don't see my calculator. There it is. All right, so let's do this. So then we got 15 divided by 35, 43%. So it's in the 43 percentile is what we're talking about there. Meaning it's not 100% and it's not zero. Now, one problem with this mathematical, thank you, Perry, you jammed on it. One thing you'll notice with this mathematical problem is that if I moved up from what we said was 55 being the high, if volatility went to here, now it's at 58. Well, guess what? If it was at 55, we were at 100%. And if we're at 58, it's at 100%, which means full boat, right? Means really expensive. So know that it can go outside those lines a little bit. The idea is we're trying to capture that general range of pricing. We can't always pick the bottom tick, and we can't always pick the top tick. If anybody's ever bought the low or sold the high tick, let me know, because I haven't been fortunate enough to get that. All right, so let's simplify options. Yes, we are in this. Now it's starting to make a little more sense. No, probably not. I want to talk about a couple of things here real quick. So before we get drilling into this, for some of you folks that might have never traded options before, we'll make this simple. The calls and the puts. All right. Now, we have the Greeks. Delta, I'll just go over them real quick. I'll start with Delta. Delta, as you guys all know, if you've ever watched one options course, what do they tell you Delta is? Well, Delta tells you how much if Apple goes up by $1, $1, then delta adjusts pricing. Like it will increase those prices by 5 cents on that first dollar. And it is correlated to its own coefficient, right? So if my strike's 39 delta, that means if the underlying moves higher by $1, I increase by 39 cents. Okay. Now, that's what most people tell you. What we learn on the floor, excuse me, is delta is data. Okay, because it tells us more than that. Delta, a delta of 36, which is, that's 39. So this 39 delta. Let's just talk about that one. At 39 delta means when the underlying moves higher by $1, 39 cents goes into these 167.5 calls. Okay. All right. But what I want you to know from this is the probabilities. Delta tells us the data of your risk. All right. So 39 delta means 39%. So this 39 equals percent. So what I like to know from delta is that my 39 delta, that means that the 167.5 call, has a 39% chance of being 1 penny in the money. All right. Okay. So it's telling me that in 2 days, I have a 39% chance of this underlying ending the day at 167.51. That's 1 penny in the money. It's got to be 1 penny in the money. All right. It can't be just at the money. 1 penny in the money. That's a 39% probability. Now, we on the floor said 2 times delta equals the percent touch, or the probability of the underlying during the life. So let's go further out here. Let's look at the 16. So what I'm looking at is this 37 delta. And it says to me that these are the 170 calls, right? That in the next 16 days, 2 times 37, which is that 37 delta, equals, what is that? 70, what am I doing? Why am I brain 74? Yes. 74% chance of it trading 170. All right. Just a 170 print. Boom. 170 prints. I have 2 times the delta of that probability. Okay. So meaning a 37 delta. 37 delta tells you at the end of the contract, you have at least a 37% probability of being in the money by 1 penny. All right. All the deltas tell you that. In the money deltas, they're higher. It's telling you there's a 90% chance sometimes that it's going to be in the money. Yes, but it might not. There's a 10% chance that it might not. What's Sal saying? Are there any circumstances aside from at the money near expiration should one be concerned with gamma? Gamma is usually definitely closer to expiration, and that's usually when I would consider it. As you can see, gamma gets very aggressive inside of that. So I wouldn't necessarily be concerned too much about gamma necessarily, but I'm glad you brought it up, because what happens with gamma is we talked about delta being the first dollar move. Well, if I go over here and look at gamma for a trade here, then I'm just going to say that, where'd it go? Gamma just goes with delta on dollar number two. So the first dollar, for instance, we got 39 cents in this example. 39 cents in that example on the first dollar move. So this would have been $1.39, right? We get $1.39 and $1.40 7, right? That would be my bid offer. If the underlying didn't move a penny, or actually moved up $1, I should say. Moved up $1, but volatility, nothing else changed. That was the first dollar. Now, gamma on the second dollar goes with delta, right? So if it moved up another dollar, then we would see gamma go into delta, and then that's 49 cents would go into those options on that second dollar move. Okay? Does that make sense? So gamma goes with delta on the second dollar. So when you're talking about the way that the prices are influenced by gamma, gamma starts doing a lot the closer to expiration. You can see gamma out here just really doesn't do anything, but inside of here, we're getting like a 10 cent boost at the end of the day, or yeah, at the end of expiration there, or near it. So gamma goes with delta. Theta is your thief, right? Theta is the thief in the night. You can see theta across the board is negative. We can see all of these prices are negative. And even if you go over to the puts, theta is negative because theta is a representation of time here. So as time goes on, the thief steals your money. And it's not like linear or binary. It ramps up. So theta way out in time doesn't even realize you're there. I don't know why I lost my pen there, but theta out in time doesn't even know you're there. Way out here, look at these theta numbers. We got like 5 cents here, 5 cents here. Doesn't even move coming inside of these 35 days, right? So now moved up an extra penny. You move in 30 more days and you get basically an extra penny taken out. Theta gets a little bit more aggressive. But look what happens inside of basically, I say 35 days to expiration. Look at these numbers just massively increase, right? So now we're talking about theta and what it would do to your premiums. I've already talked about what Vega's doing, right? We already know Vega for this underlying, and sorry, I'm making this really messy. But we already know that Vega for this underlying is pretty low. It's not super low, but it's pretty low. If it was super low, then we would be thinking we need to really be buying, right? But right now, it's kind of in the middle. So what do? Well, I like to kind of buy and sell. When it's just slightly below, I lean towards buying and then maybe sell some options against it in order to lower some of that overall cost basis, limit that theta decay, limit that exposure to Vega, okay? All right, so that would be maybe when we were talking about those quarters inside that basic 25 to 75 middle area. That's where you're kind of doing covered calls, call spreads, put spreads, stuff like that. At the extremes, you want to be thinking, I need to buy a call because it's super duper cheap. Selling something against it's not going to help you. All right, so let's go back to this Vega again. Sorry. So Vega is here, and we talked about this. 1 percentage point increase is what Vega says for its rule. Delta is $1, theta is 1 day, Vega is 1%. Okay, pretty simple. But Vega on the calls and the puts, we can see Vega is more impactful further out in time than closer. All right. So if we want to take advantage of volatility expanding, you probably want to think a little bit further out, right? But if I'm buying volatility or buying options and I want that to explode, then I kind of want to lean towards going a little bit further out in time. So if I've gotten it in my head that volatility is low, prices are cheap, I'm thinking about buying. Well, now I have to be a good steward of my capital. So if I'm buying something, I want to eliminate or at least limit that thief in the night that comes and steals our premium, right? the thief, is Theta, because every single night he picks your pocket. And he will try and pick it clean by the end of the expiration. So we could see that we could have Vega affecting us out here. We want to limit Theta now because we can see that inside of 2 or 3 days, well, that's crazy. But way out here in time, this is going to be kind of your idea as to where you want to be buying your options. All right. My thing is less than 45 days to expiration, days to expiration. Sorry, for some reason it's running off my screen, is the sell zone. Why? Because I want Theta stealing my money. If I've sold something, I want it to pick it clean, right? Sell it. Nothing ever happens. Underlying doesn't move. I just sold it and watched that Theta just rip away at it. So if I'm inside of this, I don't want Theta eating me up. I want to limit that Theta decay if I have low volatility, because I want to be buying. If I have low volatility and I want to be buying, I want to limit Theta decay. They just go hand in hand, right? So that means I want to get further out. And I usually say, greater than 70 days or right outside of 70 days to expiration is a real sweet zone to buy. And we're looking to buy today because of our volatility being low. So looking at this option montage right now, all of these numbers, you can see what the price of the 165 puts are. They're $3.50. How do I know that they are cheap or are they expensive? Nobody can look at this or even just look over here at the Vega numbers unless you are really intimate with Apple and its volatility. If you're flipping through charts, and I come by Tesla and I see Tesla's number is like 158. All right. And I look over here and it's 0.34. Well, 0.34 or 34%, I should say, actually, this is 158% when we're doing it in percent times. So this would be 34%. On the option, on the chart page, it doesn't do it as a percent. It does it as a decimal. So this is 34%. So if I just got done looking at Tesla and I come over here and I see this percent, I'm thinking, oh my God, there's no volatility over here. They got to be cheap. No, we need to compare the apples to apples, right? And no pun intended. Truthfully, no pun intended. But at 34, I know it's kind of cheap. It's not super cheap though, right? So I want to hedge myself just a little bit with this. I know I'm not going inside of any of these because I'm buying options. So none of this stuff means anything to me. Let's zoom in on what's more concerning. So it really is a pick 'em between these prices across the board here. All right. If I go out in time, this strategy, the further out you go, because the markets are getting a little wider, it makes it a little bit harder. But I like to, on this strategy, try to risk one to make two as close to I can, So basically, $10 wide, you want to risk $3.33 to make $6.67, right? So try to risk one to make two. I'm a little off on this one being a $5 wide, right? I probably should be a little bit cheaper, but it's just not working out that way today. But I am very close to it, so I'm willing to go with it. And the reason why I picked the June here is the pricing out here. This spread was around $2, and I didn't feel that I could really get that low enough to work that order to get it cheaper. So that's why I decided to skip that one. And June, it wasn't bad. I just would like to play this out a little bit longer. I think we could be more in a consolidation type of trade. If you guys watch this spot the trade videos that I talk about the daily markets, you've heard me talking about that. So with that said, I want a little bit longer time to let this trade work itself out and have the time to be right, because I could have done it in this market and come up with a very similar trade as to what I came up with. Now with this, I'm looking to buy these and sell these. Selling the 180s helps me finance the long, right? You can obviously tell if I just bought these 175s, it would have cost me $8.60. Yes, I am limiting my reward, but I'm limiting my risk. I'm reducing my risk by limiting some of my reward. And, you know, that may not be super exciting for you, but when I show you the chart on this, like if you look at a chart of Apple, and I don't think I can flip back one to find that chart. I think I'm going to be flipping all over the places to find a chart right now. So ultimately, I picked this one. I figured about 3 months is a long trade for me to be in. So I'm good with that. I'm outside of my rule for 70 days to expiration. I know I've got low volatility, so I'm leaning towards buying. If I'm going to lean towards buying, I want to limit that thief in the night that comes and steals those friggin' premiums. So I'm going to go further out in time. And because I'm not at an extreme low level in volatility and kind of near that middle, if you will, rather than the extreme quarters, then, you know, you want to hedge yourself a little bit. Because if volatility starts coming out of this trade, it could hurt me if I just bought the underlying, and it would only help me if it started expanding. I will benefit from volatility expanding in this trade because of the long call being closer to the at the monies, which are going to be affected by volatility a little bit more, generally speaking. So volatility expansion with this strategy will help me on the long call. Is the volatility percentile based on historical or implied? Barrett, you guys are crushing it today. As a matter of fact, it might have been you that reached out to me, Barry, about this, whether or not we could use, if your charting system didn't have implied volatility as a chart at the bottom. And I'll show you in a minute. So you got a little ahead of me, Perry. I'm going to try and pull in the reins for just a second, and we'll get there because it's right around the corner. And here is our risk reward here. You can see we're risking 180 to make 320. Not quite a perfect risk one to make two, but it's pretty close. Enough for me, especially with my bullish assumption here with this underlying. I'm not as concerned about that. And for folks that are wondering why I picked that 175, I think that if we start popping above this 50-day simple moving average, we got the 180 Fibonacci's right there. So that's kind of where my resistance is. With this strategy, I'm going to look to cover it as soon as I get 2 times the delta, the probability of touch. If I can get the underlying hit my 80 strike, that short strike, I'm going to be pretty much at full profit. It's not going to be everything, but it'll be enough for me to want to get out of this trade. So when I do a strategy like this, where I'm looking at the long calls, why does that work sometimes and not all the time? Sometimes when I do that circle, it wants to do the pin, but so literally I'm getting above this 175. So I'm looking at buying the 175s there and selling the 180s there. So if I can just get a little bit of a pop, even if it just goes up and touches my 175s, which has a high probability of that happening, I'm going to see this trade start to work out quite nicely. Now, some folks will talk about doing this strategy using in the money options and selling the out of the money options. And I've done courses on that where you're trying to just buy that strategy for what it's worth, really, for the benefit that you're entitled to. But at the end of the day, if this trade goes sour, I'm risking 180 bucks. If my in the money strategy, in the money with the out of the money short call, if the underlying goes south on me, it's going to be painful. All right. It's going to, because I paid so much for that strategy. Now, back to Perry's. Now, I've not traded. I don't know where my chart went. So let me pull up let me try and find a chart of, I guess I'll go to pen. So with this, I've got the charts down here because I started looking at it after somebody reached out to me about it. Now we can see that it does follow it pretty closely. Now it does get a little bit over and doesn't maybe get the extremes, but I would say that you could use historical volatility. I would prefer to use implied volatility. I like implied volatility because it's forward looking. Historical volatility is what we've already seen. But to chart it in order to determine whether prices are cheap or expensive, yes, if you don't have implied volatility, you could definitely use historical volatility for this. Does that answer your question, Perry? All right. And that's about it, folks. I mean, I pretty much covered everything for you. If you have any questions, I will circle back around. I'm looking at the comments, the comment sections for questions. And I do circle back around over time a couple of times to make sure that folks that have watched it later get their questions answered as well. And please, folks, smash that like button before you go. It feeds these bots that runs out there and finds somebody like you to share this information with. So if you had a light bulb moment, anything started making sense to you, think that somebody else would benefit from that, please help me out by smashing that like button. And if you guys want to take advantage of daily market commentaries and get notifications when I show up unannounced, hit the subscribe button and right next to it, the little bell. The bell will give you the notification coming in unannounced. Subscribe will just let you get information when we're doing videos. All right. You won't always get that so timely. And for that, you know, since we are starting a new course here, I'm going to throw out a course or a deal for you guys. It's basically the Wolfman's options lab here. What we do is we have groups where we talk, brainstorm, come up with different option strategies for different assumptions. And then we also have discounts, promotions, and I also will reach out to you back and forth. We can have phone conversations back and forth in emails. Make sure you folks are clear of concept before moving forward. I want to make sure that you folks are taken care of. So please, you know, beat me up with the emails. I'm happy to answer you guys. So that's the question and answers, any of that stuff, and full access to all the courses. There's a huge bank in there that has them, and once you watch them, you can check it off, and you are good to go and move along. So that link is, like I said, in the chat window there. And that's all I got for you guys. I hope you guys enjoyed this. I seriously hope you guys can implement this into your trading regimen at any given time. At least you know now when you're walking in there, I know whether they're pretty cheap or whether they're pretty expensive, right? So if you can walk away from that, you know when you should be selling options and when you should be buying options. And I hope that changes your trading and for the better. All right. That's all I got for you guys, except for one last thing. If you can't take that, take it easy. Bye for now. Roger saying, I'm using Steve Primo's strategy number 4, but the signals typically offer a higher % probability trade. You know what? I always say that if you can mix a little technical analysis in with trading, then you can turn the probabilities in your favor a little bit more. For instance, you know, quote unquote, your probabilities, if you went out there and bought a stock, is 50-50 that it'll go up or down right after you bought it. All right. One tick up, one tick down. That's a 50-50 probability. Now, if you've picked support, used candles, see the markets reacting, confirmation, all of those things, yes, I absolutely believe that you have turned the probabilities further in your favor. And while it only says I have a 37% probability of being in the money by 1 penny, I can see that the chart is turning around and momentum is shifting to the upside. So yes, I'm absolutely in your camp on that as well. So great points. I appreciate all the questions, comments, and kind words. I know I got you. So appreciate that. You guys all take care now. Don't forget to hit the like button before you go. They aren't limiting those. They aren't going out of style. Actually, they are going out of style. So hit it. Bye for now.